Well, if you looked at that CPI number, that model, today inflation is running 8%, not 1.3. It's a joke. And I know that real estate prices in America are up 10% year over year. So how can you say there's no real inflation?
Hello and welcome to Assay TV. As you can see, it's late here in Hong Kong, but we're about to go over to what looks like a sunny morning in San Antonio, Texas, to hear from one of the leading thinkers and opinion formers in the gold investment space. He's the CEO and Chief Investment Officer of US Global Investors. We're delighted to welcome to Assay TV, Mr. Frank Holmes. Frank, great to see you. How's it going in Texas?
Outstanding, my friend, and thank you for the very kind introduction. We're doing very well. It's interesting. Last week I had dinner with a group of CEOs with the governor of Texas, and he commented that the political regime, what's going on, and what he did to deal with COVID is he basically called up 35 CEOs in every different major industry to help them out. And Michael Dell gave the logistics because they weren't getting masks, and they built a big facility here. And so it's interesting to see how he tapped into CEOs and their executives to deal with this whole COVID issue. But we're in very good shape. I've lost weight. My cholesterol's down. I'm running a lot. I'm not flying. So lots of positive things have come from it. And we've had this spectacular, unprecedented growth in ETFs because of millennials.
Absolutely. I mean, gold's obviously been on a massive run this year, but recently had a bit of a pullback, which has caused people to think, is that the end of the rally? What's your take on that?
Well, we quite often write about life is about managing expectations. And it's from the great Warren Buffett saying, if you want a long-lasting marriage, you have low expectations, because then everything is on the upside. It's just realizing for investors the DNA of volatility in each asset class has its own DNA of volatility. Interesting enough, most of the talking heads in New York, CNBCs of the world, are all negative on gold for whatever reason and say it's more volatile than the S&P. Actually, they're exactly the same. Over 1 day, 10 days, 1 year, they basically have the same DNA of daily volatility. What's interesting, gold stocks are about 3% more. So the daily volatility of bullion is 1%. Gold stocks are 3%. And when we start looking at 20-day rates of change and 60-day rates of change, which is a quarter, and 1 year, what we had happen in the beginning of August was a 2 standard deviation move over 1 year, over 60 trading days, and over 20 trading days. And that said, mathematically, there's a 99% probability we're going to get mean reversion. And when all those stars are aligned, so we've seen the 20-day now fall of 1 standard deviation. So that means it's fallen 3 from the peak. The 60 days back to the mean, and the 1 year is still up just 1 standard deviation, not 2. So we're in a normal correction in a secular bull market in gold and in gold stocks. Gold stocks this quarter will have record free cash flow yields. And for the first time in 15 years, the industry of 88 global gold producers we track, it was in March of this year that the S&P's positive free cash flow yield went negative because of COVID, but the gold stocks went positive. Very important. June, stronger growth, and this quarter is going to be fantastic.
Are the generalists taking note, though? I mean, as these companies are bringing out their quarterly reports and gold companies start to announce that they're making a profit while other major companies are making terrible losses, are the generalists going to wake up to that?
I think the generalists are slow motion. What's important is that the 50-day has remained above the 200-day moving average, that golden cross trend line, for 19 months now. And I think that trend, and even with the volatility, Buffett came in and he bought Barrick, which has high free cash flow yield. And they bought it as a gold production. And that was a big sea change for him to come in and buy a gold stock. And he says that gold bugs basically drop so many emails and letters to him anytime he talks negative about gold. So I think that swarming, that great respect and admiration they have for the Oracle of Omaha, Warren Buffett, buying a gold stock will create this new trend change.
And I guess, I mean, Warren Buffett is obviously famous as a person who buys and holds, rather than someone who jumps on a sort of a short trend. So that must be, a very positive sign for the long-term trend for gold and gold stocks.
And I think a lot of the gold CEOs now are much more mature, and boards of directors are much more responsible in this sort of silly runaway M&A work that was non-accretive. What our quant models have shown us is that the revenue per share, if it gets harmed on a share merger on a per share basis, the total number is bigger, but on a per share basis, it's actually dilutive. Those stocks get put in a penalty box for 18 months. If you have the revenue and the cash flow but also impaired, it's even more severe when the correction takes place in those stocks. They're orphaned. So I think that we're seeing some of these acquisitions where management's coming out and articulating that, and more companies are talking about they have a free cash flow yield. Well, that's extremely appealing to the growth fund manager, like Investors Business Daily looks at the IBD top 50 best growth stocks in America. Franco-Nevada's there. Kirkland Lake's been there this year. These are important changes that will get the generalists coming in, as long as management and boards of directors don't do silly deals to cannibalize their value metrics on a per share basis.
Well, we had a deal down in Australia today, I believe, where Northern Star and Saracen sort of came together in a merger, in a sort of zero premium sort of merger, as sort of a more conservative, sort of sensible approach to M&A. Maybe the CEOs have learned their lesson from the last boom and bust.
I think so. And what happens when they get that critical mass of 10 billion and they have a free cash flow yield, they will attract bigger institutions. Right now, Canada, it was 8% of the stock market's gold related. The institutions are only 1%. It's their industry. The same thing in Australia. Most of these institutions are pension funds are underweighted. So I think we're going to see this gradual change in each quarter that we have a free cash flow yield for the 88 global gold producers an average, then it will start to attract more money to this industry.
And in terms of where you see the gold price going,
look up.
and the timelines for that?
Well, I've written about it, and I went back and I looked at other sort of periods when you've had this incredible printing of money. And so it's important to look at the G20 finance ministers. After the tech bubble, you all of a sudden saw them become consumer synchronized trade. And China came into the game, and we had a big run up in gold and gold stocks in 2008-9 period. Then all of a sudden, these G20 Federal Reserve central bankers equivalent and finance ministers became consumer synchronized taxation and regulation, where now they're spending $1 billion a week on anti-money laundering laws globally. That's pivoting now. So it's dealing with COVID. They're all collectively saying, let's all print money. And you're seeing this currency debasement, and not where one country is doing the other. They're basically doing in unison. And so I think that if you look at how much money was printed by the Federal Reserve in 2008, 2009 was $3 trillion expansion of the balance sheet. Gold went from 700 to 800 range to 1900. If we look at this expansion of the balance sheet and we forecast it on a similar pattern, then gold can easily be $4,000.
And does corporate borrowing come into it as well? Because I know, in terms of companies issuing bonds, there's been a vast amount of bond issuance and people drawing down on their debt in the last few months.
Well, the debt equity ratio is important for screening stocks, not for picking stocks. It's interesting. If you said just buy me one with the lowest debt to equity ratio, it doesn't mean your overall top 10 names will outperform GDX or GDXJ. But if you only looked at that universe, the top half, have more attractive balance sheets, and you did your other screens, then it becomes more valuable as a tool.
But it's interesting that it's the gold miners, the gold producers at the moment are the ones who are not needing to to borrow. So their debt to equity ratio is going to be fantastic compared with a lot of these other companies who are
airlines,
loading themselves up on debt at the moment.
Yeah, I know that. I agree. But I can share with you that's why I'm surprised that Buffett did not buy Franco-Nevada. I mean, he loves royalty companies. And when you look at a royalty company, it's like a tech company. It's got this monthly recurring revenue, and it's lower volatility than Franco-Nevada's revenue per share and cash flow per share and margins are much more attractive than Barrick and Newmont, where they get the royalties on them. That he hasn't bought into that. Whereas the largest hedge fund in the world, Ray Dalio's Bridgewater, they own Franco-Nevada and Wheaton Precious. So you're seeing that sort of morphing taking place in the capital markets.
Well, I suppose there's always time for Warren to buy a few more different other things. What's your take on the silver market? Obviously, silver, I guess, went up in percentage terms more than gold, but then also came back down harder. Where next for silver?
Well, it's a nice question because it's an important question. And when you look at from a quant world, agnostic from supply demand factors, what has happened is that the DNA, the beta of silver to gold is 50% more. So if gold goes up 10%, silver goes up 15%, but doesn't do it at the beginning. All of a sudden there's a lag where gold is going up and up and up, and then silver has this huge surge, and then now it's outperformed gold. Vice versa, if gold corrects 10%, silver falls 15%. So anyone buying silver has to recognize that DNA of volatility between the two. I like to say that silver is the warrant on gold. And a warrant on any gold stock is always more volatile than the underlying gold stock. And interesting enough, I was on a panel of bullion dealers and coin dealers that deal in numismatics, and one of the big dealers was saying that a huge number of silver coins are getting exported over to Europe and Asia. So I think that we may see the interesting, if this trend sustains itself, then we're going to get really fascinating supply-demand factors that could pivot silver even higher.
Interesting space to watch. In terms of all this money that's being printed, are we seeing it now starting to be reflected in inflation numbers?
No, and that's why I love John Williams' research and shadow stats. He goes and basically takes the algorithm or the model that create the CPI index that was used in 1980 when gold hit $850 and silver hit $50 an ounce. And Volcker came in to basically put prevent any more inflation and halted it. Well, if you looked at that CPI number, that model, today inflation is running 8%, not 1.3. It's a joke. And I know that real estate prices in America are up 10% year over year. So how can you say there's no real inflation? Rentals are rising also. So I think that inflation is a big issue here. I've noticed on flights even because of our Jets ETF, the flights, if you want to fly to Colombia, it's just open now. One way is $1,000. That was a return ticket. So that's big inflation. Now, domestically within the country, there's pricing power that some of the flights have dropped. But really, the number of options to fly has dropped dramatically. So they've been allowed, hotels have done the same thing. They only allow half the hotel to be functioning. And so therefore they have pricing power.
But is that a function of just the prices that we're going to see during the sort of crisis and the immediate aftermath? Or is that a long-term inflationary trend?
Oh, I think that we have to look at dismal scientists and these other types of dismal stats and shadow stats. There's all these interesting characters, but shadow stats is the best. And John Williams does a great piece of research on this. Inexpensive newsletter if you want to have that sort of look at it. And I just think that his data points have been so strong since the year 2002 that inflation has been greatly understated. And what have we had? We've had a secular bull market in gold. That gold has outperformed the S&P 500 almost 3 to 1. And the biggest hedge fund in the world, Bridgewater, has always had a position in gold and recalibrating it. And that's helped them have this great low volatility, high performing hedge funds with over $150 billion in assets. So I think that the fact that gold has been such a stellar performer says that there's understatement in these inflationary numbers. Remember I said earlier, the G20 finance ministers function like OPEC's cartel. They're all got a synchronized taxation and regulation. Now it's synchronization to fight the invisible battle of COVID-19, print as much money, keep the economies going, whatever you have to do, keep the engines going.
Mm. I mean, you've got a little election coming up there in the United States. What's your take on what the impact would be of either a Trump win, a Biden win, or a contested result?
Well, I think that there's so much emotional turmoil. I see in my own office, sort of anti-Trump, and he clearly is not has a lot of finesse. That's just very evident. But there is a whole group of leaders, and especially when you go into rural America, and I was talking yesterday to people dealing in Africa, that these tribal leaders, they like him that he calls it as it is. So I think it's a jump ball. Basically, they say that 87% of the time, the president gets the second term, becomes the president. I've never seen such a concerted effort. Microsoft came out and said, wrote about this on the weekend on our Investor Alert, that Russia's Putin has been with his KGB operatives, infecting elections all over the world. This year is not just America. America is only 5% of the world's population, but the biggest GDP in the world, so it gets most of the limelight. But there have been lots of interferences, and what they want to do is divide and conquer. They love seeing all this turmoil, why Democrats, Republicans fighting with each other, protests in the streets. All this stuff appears to be orchestrated from outside to come in to interfere with the stability of our overall economic engine. Now, remove that, and the quants are 70% of trading. They're agnostic. So this is very important to recognize. The quants turn around and they're just looking for filings every day. They're able to code and then to make a determination quickly as it's bullish or bearish for markets, analyzing what the Federal Reserve is doing with negative real interest rates coming in, and for the first time ever buying ETFs to drive down tax-free bond funds, the yields, to drive down corporate bonds. This has never happened before. So they all of a sudden take that money and they're buying stocks. So I think the better part is to follow the barometer of what the stock market is telling you, and PMIs. I write about PMIs every month. The PMIs are so important for commodity demand, and they're very bullish. The 1 month is above the 3 months. They've been doing that for 3 months in a row. That is highly correlated to the rising trend in copper, to iron, and nickel's going to have another big stellar performance. So I remain very bullish and constructive on this industry.
So either way, I mean, everyone's getting in a big fuss, but the markets sort of think, well, it'll just be carry on and onwards and upwards.
That's what it's doing. And interesting enough, the socialist mindset of Europe, the EU with all their MiFID II and the socialist policy they've created, that $1 billion of research analysts lost their jobs in New York 18 months ago. It's just tragic. It doesn't matter. They're buying U.S. stocks. So on one hand, you have all this negative media, and you turn around and find out something that's never happened before. The Swiss fund money, and no one buys it but themselves. They print this money, they buy Apple stock. They're one of the biggest shareholders of Apple. They're buying great U.S. technology stocks, which have free cash flow and growth in revenue last quarter and cash flow last quarter over 4 quarters. So Japan has done it. Japan has used ETFs to become owning 15% of their stock market. So I think we're in a new world of zero interest rates, negative interest rates, government policies to print all this money, and gold is clearly the 4th most liquid asset class in the world, and it's going to shine.
So going forward for the rest of the year and into 2021, US global investors, where are you what sort of companies are you looking to invest in?
Those companies that articulate themselves of their discipline on free cash flow, and not growth for the sake of growth. If they're M&A work, that they recognize now that deals have to be accretive. Otherwise, we sell them immediately. If company A buys company B, and we can quickly through our quant systems determine if it's accretive on reserves per share, revenue per share, cash flow share, and both are gone. Take my money, go somewhere else, because this math suggests that there's an 18-month penalty box until they get all the paper done, they actually get economies of scale, and you must have much higher gold prices. I'd rather put it in something else where I think I can get a much higher return on my capital.
But beyond mining companies, gold mining companies, any other commodities you particularly like the look of?
Well, I mentioned earlier, I think nickel, silver, clearly copper, gold porphyry deposits. You can buy these stocks a lot cheaper than buying a gold stock on a cash flow basis, etc. At the top of the cycle, they all trade in the same cash flow multiples. So if you're a value investor, I think you want to look at the copper gold assets that are out there, and I think that they're the ones that are going to give you a longer term picture, a big bang for your buck.
Fantastic. Well, Frank, that's been a fantastic, some insights there into the markets and where you see things heading in 2021. Thank you very much for joining us today and being such an enthusiastic participant on Assay TV.
Well, thank you, my friend, and stay safe.